Hi, everyone. Welcome to another episode of Bitcoin Intelligence. Today, Wizard and I are going to review the market status and discuss some news about the Bitcoin Intelligence and the last edition of our report. So, market has been interesting lately. Lots of movements in the last couple of weeks. The game has completely changed. Every weekend we are getting some news that completely changes the previous analysis, and we just have to constantly be watching the developments. But after Monday, when they announced the agreement with China, we haven't had much moves in the market. Pretty much all of it happened early Monday, and Bitcoin has been kind of in a narrow range, a slight up and a slight down. Let's see what the analysis says about what's coming. Hi, Wizard. Welcome to the show.
Hello, Sina. How are you doing?
Doing great. Thank you very much. Excited for today's discussion to see what your analysis tells us about where Bitcoin is going. So let me share a few ideas that a few data points that I've seen recently. But yeah. Okay. So now you should be able to see my screen. How can we, yep, smaller. All right. So as you can see, Bitcoin has done a fantastic recovery from a low of 75, which is pretty significant. All the way up to 105, I think, was the higher number we got to. Pretty amazing, like in 1 month, significant increase. And hopefully you were following our reports in this region where we were constantly taking a directional view that this is one of the fantastic places to invest. Again, one of the things that we think is different with our show is that we also do add clear, actionable analysis with direction rather than looking at both sides and not making a real conclusion. So, and this basically gets us to a risk score of 60, behind my computer, 61%. It's still showing that it's not heavily overpriced or not risky. We are getting into this yellow region. If we actually move forward, starting at 109, we get into a region that's historically an acceleration zone, like what happened here. It actually can work both ways too. And if you look at the longer term view, that yellow region is essentially the transition between the boring, the transition from to the best parts of the bull market, basically. And then the destination is inside the red region and orange region, which I call them risk regions. And here you get to see massive volatility here, like this one, and what we saw in prior cycles. Similar in the orange region, you get a lot of volatility, lots of moves. This is max volatility, and then from there, that's basically the region from 160 to 200K by year end. So that period is risk. Anything above 200K would put us in the top, based on historical pattern, would put us in the topping region. So I don't know where we'll end up. Maybe we don't go all the way to the 99th quintile. Maybe we go to some lower number or even higher number. But this model clarifies that this region is highly risky. All right. So, but we are far from that. We haven't even entered the yellow zone. So that's good. Another valuation model that we have is just a basic power law regression on the price. And it shows that the average price of Bitcoin for this time of the year has reached 96K. We are slightly over that number, and which is also visualized in the VPLI index. It is 53 out of 100. 50 is super neutral, and we're slightly above neutral valuation. And for us to really top in the cycle, it has to really get into very, very overvalued regions, which is, again, far from where we are. So for a long-term investor, Bitcoin is very fairly valued at this point. All right. Now, looking at today's volatility, of course, in the last few days, Bitcoin has been ripping, but today was a little bit weak. Bitcoin sold off, but interestingly, gold sold off a lot. And so here Bitcoin has correlated with gold, but on the downside, nobody talks about it. When Bitcoin goes, like gold goes up and Bitcoin doesn't follow, everyone is like, oh, the correlation is broken. But Bitcoin sold off, gold sold off, but interestingly, bonds, TLT, also sold off. And this basically indicates that people are selling these liquidity sources. And where is it going? It went into NASDAQ. So today's price action showed that people took some, basically took profits. Gold has gone up a lot. Bitcoin has gone up a lot. They took profit, and bonds have just been not attractive. So all these things are being sold for investors to move into NASDAQ. S&P is not really moving, but NASDAQ is where most of the money is going. And also the emerging markets. This is an index for emerging market. That also went up. Again, that's where money went. All the laggards. People are essentially, the trade that's happening is people are saying, you know, I've made a lot of money in gold and Bitcoin and other assets. Let's take some profits and go back to stocks. Why? Because we were so worried about a recession. Now that recession probability has gone down, stocks are becoming more attractive again. But in my opinion, this will quickly also begin supporting Bitcoin too. This is kind of a short-term sell the news event that's happening for Bitcoin. Bonds, as you might have seen, are doing really terribly. Trump administration is doing all they can to bring down the rates, but the rates are actually going the other way. 10-year yield was below 4 before Liberation Day. After all that tariff turmoil, it went above 4, which caused Trump to blink, and then now it has climbed up to 4.5. Investors are dumping treasuries, which is not something pretty, and this is an alarm bell for Trump to begin rethinking the stance on tariffs and economy. So the economy only has a limited capacity to absorb uncertainty. If they keep up and if they don't deliver more deals, things will get ugly. Especially the worrying sign is that they delivered a pretty good thing with China pausing tariffs, but the bond market is still selling off. So that's pretty bad, negative sign. And it might actually also begin waking up the Fed. But going back to the idea of rotation from outperformance to stocks, you see recession probability, at least what Polymarket prices, has gone down significantly from 66% late April to 39%. Again, most of this is because when tariffs were on and Trump was saying that he has no interest in negotiation, recession was the outcome, was the expected outcome. But as he's changing tune and he blinked a few times, and as China is also showing willingness to negotiate, as both countries seem to be on the path to drop the rates and the tariffs, recession and the worst outcomes are being taken off of investors' expectations. So we are now looking more at an economic slowdown, because whatever deal they make still seems like at minimum of 10% and probably higher for China will be present, and that still will have an anti-growth effect. So moving on, a few signs. I mean, at this point, we have been basically bullish since the crash happened to risk assets, but now the stocks have recovered and Bitcoin has recovered pretty fantastically. I think almost recovered all of the losses. The risk at this point is if the damage that was done in the last few months due to uncertainty with tariff deals start to appear. How would it appear? Businesses now have accumulated a lot of inventory, right? So Q1 GDP was supported by that increase in economic activity because everyone had to front run the tariffs. They had to buy much more. They have to move much more, store much more. That all means the United States supply chain were overactive, so much more activity than usual, and that's supported that. That's probably why we're not seeing a breakage in the job market. But in Q2, we will start to see the effects of tariffs show up. People are not going to buy as much. Rates have actually, been implemented since April. That 10% is there, and retaliation is also there. So both imports and exports will take a hit. Plus, a lot of it also was front ran, so much less is going to happen in Q2. And also because businesses have a lot of inventory, there's just a lot less work. They've done the work in Q1, so we should see a real drop in economic activity. So we don't know if that will turn into sizable layoffs that would shock the market or not. That's why we have to really, really carefully follow the job market. And here, one statistic that caught my attention posted by Kobasi was that permanent job losers, which is people have been laid off, but it's permanent. It's not a temporary plan. It's kind of like the business closed or they were permanently laid off. That number has did have a smaller reading initially, but now jumped back up to 1.9 million people. And we also see a small increase in initial jobless claims, which in the last few weeks it had a major spike, but now it has stabilized at a high level. So we have to continue and see if it ends up being a trend. But the labor market so far, knowing that it's a lagging indicator, so far it still hasn't shown any worrying sign, and there is upside power left. Another thing I would carefully watch is the job vacancy numbers. This was one of the most important metrics that the Fed was looking at during the pandemic. These are new jobs that are being advertised, and that has completely gone down all the way to pre-pandemic levels. This can also be one of the more leading indicators. Before you even think about laying off people, you stop advertising new jobs. So that should be a really helpful indicator. We'll keep watching this. Now, if you want to be up to date about what's happening in the market and access our research, you need to go on 21stcapital.com and using this link, 21stcapital.com/BI, to read our report. The latest report we had just came out on Monday, right after the deal with China. We had a quick introduction about the deal, what happened, 10%. So the reduction of the 145 and 120, 145 from US, 125 from China, reduction of those tariffs to 10%. And then some more, a lot of tariffs are actually now remaining too. The 10% blanket ones and 20% fentanyl tariffs are there. And then on the China side, they still have the ban on rare earth metals, and they have their own retaliatory tariffs at 10%. This is paused for 90 days, and 3 months later, we'll see where it goes. But it really seems like the Trump administration is intent on making a deal, and because they understand that their time is up. Now, then in the rest of the report, we looked at the market moves. Of course, Bitcoin did fantastic since the early news came about the deal. But on the announcement, it had a little bit of a sell the news effect. And we didn't really think it's going to be a major crash. It really seemed to be a minority of the market trying to take profits. And then we looked at the Onchain Data, which was overall pretty positive, showing that demand is coming back on the margins, showing that there was a lot of short liquidation, and the sustain the continuance of the rally depends on new demand coming in. Let's see. Yeah, we also observed a pretty significant short squeeze. There is also a lot of shorts right above 104. So if we actually get to 105, a lot of those shorts will be liquidated, and we get more fuel for expansion. So let's see what happens. But the other thing I'll mention is this is the first report that is premium. So typically from now on, we'll have half open and half premium. So you have to sign up for our service. We have just launched it on Monday. We had a promotion for the first 100 people to join from my Twitter followers, and it was supposed to go on for 10 days. I think we are 2 days in at this point, and I think it's all exhausted. But in the off chance that there's 1 or 2 slots, I don't have it here. No. Yeah, but you can try the Insider BI all caps promo code to see if there's any spot left. Sign up at a discounted price. Otherwise, you can simply sign up as the full price if the promotion has ended. You can do monthly and yearly, and what you will get is our constant research and development on Bitcoin models. We have 3 base models that you are familiar with, but we've just added a new cycle model as well. This is a model that projects the future path of Bitcoin according to the prior cycle's trajectory. So for example, this white curve shows where Bitcoin is likely to go if we follow the path of the prior cycles. This is a combination of our quantile model findings and a new cycle model. So one interesting finding here is we're actually not far from prior cycles. So you have heard probably that Z and I believe that cycles will not repeat similar to the past. It's going to be a lot more subdued, but all that is considered in this analysis. And if as long as at least some of the timing is similar to the prior cycles, we can model the future trajectory that way, and it's very similar. I mean, I wasn't even expecting this level of closeness. That model basically says we should be at 110 now, but the current price is at, I guess this is a few days old actually. The current price has caught up quite a bit to this. So we are actually not far from historical pattern. Very interesting. Now, and then you can also find all of our reports and so on, and our video analysis like this one will be placed here. All right, with that, I'll stop and I'll let Z discuss his on-chain data. Did I speak too much?
Never. Very interesting.
Too kind. Thank you. So what's going on in Bitcoin land and on-chain? What do you understand from behavior of users as we've had this massive rise in price? Yeah. I'm expecting a lot of people are taking profit, and your analysis could tell us something about cost basis of people and potential important support or resistance levels based on on-chain data.
Sure.
What do you see?
Do you see my screen? Is it like clear to you? Okay, let me make it.
Yes.
Let me make it a little bit bigger. A little bit. Okay.
No, this is fantastic. You're doing full screen charts, which I love.
Yeah. So I gotta admit, like especially last week or the week before, I was bearish. And I mean, like you said, we try to be not recklessly, but a little bit more directive when we are talking about the charts, and just honestly share what we think. And I was bearish, and to be honest, still I think that was really hard to read. And so excuse my bearish tone if I just keep sending some negative signal. But that being said, our breaking above the cost basis of the short-term holder, which was around 93,000, is a very significant sign that I was not expecting it. So looking at this chart, I'm going to explain why I was not expecting it. Here, the black line, the black trace line is the price, market price. The red is the cost basis of the new investors. As you can see, like 2016, for example, 2016, 2018, bull market price stayed above the cost basis of the new investors. What is the implication? The implication is if price has a strong momentum and stays above the cost basis of the new investors for a long time, the new investors are going to get, it's like a loop. They get more confidence. They make it get more confident. They start to put more money. New investors are going to join the game. And that loop is going to keep going until it's just, we are in the euphoria and market doesn't have enough demand to, it doesn't have enough demand to face the sell pressure by the long-term holder or whoever is start to sell. So as far as we're to stay above the cost basis of the short-term holder, we can say we are either in euphoria or we are having a high chance to come back to euphoria. As soon as you break below the cost basis of short-term holder and stabilize there, by stabilize there, I mean 1 week or 2 week, you stay there and the short-term holders start to realize the market is losing momentum. That dip that we saw yesterday looks like it's not going to just be recovered really fast. Then fear is going to grow in the market. Then the short-term holder will get into the situation that, especially the new ones, the paper hand one, might start to spend at loss. So the price breaking below the cost basis of the short-term holder is an early sign of trouble. And as you can see, 2016, we temporarily for 1 or 2 days, we break below the cost basis of short-term holder, but we recover fast. If you go back to the 2019, 20, 21 bull market, we saw the same pattern at the early stage of the bull market, the recovery from 3,000 to 19,000. But then we start to a sideways, and then Corona happened. We had a huge crash in the market and strongly leg down below the cost of the short-term holder, recovered a month after. But since May 2020, all the way to 64, 65,000 all-time high, price stayed above. And then we had China ban. We stayed a couple of weeks, extended a couple of months. What we saw this cycle starting January 2023, we are experiencing a similar pattern to 2016, despite the fact that the performance is not as sharp as we saw in 2016, but staying above the cost basis of the short-term holder was really interesting. So right off the bat, you could say this cycle is similar to 2016, 2018 in terms of how mature market is behaving, how much spot market is actually driving the market up versus 2019, 2020, and 22, which derivative, especially the second leg to the new all-time high, was, I cannot say purely, but very significantly driven by the futures market and derivatives. So that is a positive thing, that we had a spot-driven kind of mature cycle so far. And looking at the all-time high before the halving, we could say the list of evidence that the 4-year cycle is gone is getting longer and longer, and staying above the cost basis of short-term holder for such a long time. And after breaking to 70 something thousand, again coming back above the cost of the short-term holder is another sign that the 4-year cycle is pretty gone. And now we're correlated with the all other markets. Market is not too small that a bunch of entities can come in and inflate the price. It is so hard to move the needle. And that being said, breaking above 93,000 was very significant in that term, because breaking below and stay there for almost 1.5 months was a very negative sign. I'll tell you what, like if we go back, and I'm going to say 120, and then I'm going to justify why 120 is so important. that four-year cycle is already gone. Like we have enough evidence, enough example of saying, hey, the 4-year cycle is gone because we are seeing shorter bear market. We are seeing not as deep as 2019 or COVID crash dip bear markets. Mostly the bear markets are going to show themselves by their time component. And if we were about to repeat this previous cycle, another cost basis that we have to look at is the true mean market. If I want to simply explain what is true mean price or true mean market price, it is the cost basis of the active investors. We are discounting the coins that are mined. We're just looking at the coins that are being purchased or acquired in the secondary market, and we are discounting the inactive coins. So we literally look at the active part of the cycle and look at the cost basis of them. If you look at that, cost basis is around 66,000 in every single cycle. That price model acted very nicely to spot the midline in the market, meaning when we break below, the bear market is very painful. The bear market is the loss is very dominant, and we have not even get closer. Yes, 74 was the closest we got, and we had a crash in August 2024. We got very close to 49,000, and the true mean was 45. But still, we have not even got close to that cost basis. That was the cost basis I was expecting to reach after the trade war with China was intensifying, and they were saying, okay, China might go 145% potentially the tariff on China. So that was the price line that I was expecting. And as I said at the beginning of the on-chain analysis, I was really shocked that we didn't get to that price. That means the spot-driven market was so scared of missing the opportunity that they entered the market, even though there is not much clarity in the macro. It's better, okay, as you explained perfectly. It is better. Things look like it's recovering from that extreme fear sentiment in the market. And if that's the case, that means, and it's another evidence that the macro market is a stronger factor after the ETFs launching in the US, after the institution getting a positive signal from the executive order on SBR. So these are all changing the nature of the market. So enough.
If you go back to previous one, but I think one way people can use this analysis is maybe after we are done with all this FOMO cycle, maybe in 1 year, once Bitcoin wants to take a break, that true market mean, the blue curve, is a very important line to watch. So that has probably climbed up to 150 at that point, or maybe 120, 30. And if you drop below it, then another bear market will probably start.
Exactly. And by, like, if I want to just come up with a name above the cost basis of short-term holder, that means extreme bull market. That means we have a very strong momentum in the market. Between the cost basis of the short-term holders or new investors and true market mean, I can say we still have a chance to continue the bull market, but it is a sideway. It is a undecisive range. Below the true mean, it is like the Bitcoin maximalist put it, is a lifetime chance. No one can say how far we're going to go below that true market mean. And well, we have not even been able to touch it since I would say November 2023. But if we go there, like we needed FTX, we needed the Luna, we needed 3 different major crashes last cycle to be able to crash all the way down like 30-40% below the true market mean. But China ban, it got bounced back here. So getting there is looking less and less likely. But personally, I think we could have another cycle or another I don't know, pain in the market. I don't know. I was expecting from macro side, not like a big entity just blow out like FTX. I was expecting something in macro happens and cause the fear, and we touch the 64 or true market mean. It was more like a hope, not an analysis. But I gotta say, I was really surprised that we didn't see it. That being said, if you want to compare the current status with the recent all-time high, or compare with the post-China ban all-time high, we can use MVRV, which is the same concept of comparing the price with the cost basis. But here we compare the price of the spot market with the cost basis of all investors. including Satoshi, which cost basis is almost zero, exchanges everywhere. Like we're looking at every single coin and looking at the cost basis of them, and then aggregate and calculate an average cost basis of for all coins, circulating coins, and then compare it with price. Here you can see if the MVRV is around 2 almost 60. I have to zoom in, sorry. It's around 229. That means on average, the investors, Bitcoin investors, are at 30%, 2.3. That means 130% above their cost basis. If we use a statistical band, which is the standard deviation, one standard deviation, two standard deviation, and say, hey, one standard deviation seems like the tops in the market, and two standard deviation usually show that we are at extreme euphoria, like very overheated. We have not seen that extreme overheated situation in this cycle, which is very well expected. If you go back all the way to 2011 to 2014 and compare it to every cycle after, you could see there is a degrading happening in the peak in the market, which is very well expected because market is maturing, market is getting bigger. The volatility in upside is very, very hard. Like if you want to move market cap by 2%, you almost need as much as the market cap in 2014. It's just crazy amount of money. So that peak degrading, and you see there is a curve, kind of like a trend in the peak downtrending. It's very well expected. But the funny thing is, up to 2023, the bottom of the bear market, you could almost see the downside volatility stayed intact. What is really interesting, very, very interesting, we are experiencing something again like 2016. For a long 1.5 year or 1 year of 2 months, we were seeing this reaching to the overheated and heated, and then breaking below the heated, and we were like kind of base for the MVRV. That means we had a prolonged bull market. What is happening here is very similar to 2016 market again, but instead of fast recovering to the new all-time high and then fast recovery to another one and just making a base for the bull market, it's like market's taking its time. Especially when we have a crash, it looks like we have a patient buyer. We are not seeing that crazy buyers, especially when market having some discount. This is very interesting. If we get to the one standard deviation above MVRV, which I linearly want to extrapolate, it's around 121, 123,000. If we get there, that means the amount of risk that using this metric we can estimate for market is as much as we saw back in December 2024, is as much as we saw in March 2024. So it's very similar to the all-time highs we experienced twice in this cycle. But at the moment, the risk from the all investors perspective, from the cost basis of all investors, it is not as elevated as what we saw. And if you see,
that's an important point. So let's make a conclusion. So if we go to 120, it's similar heat as the high after Trump election or the high after ETF.
Yeah. And that being said, even so far, like even getting to this price, because I was saying, okay, let's go back to 2020 and then China ban, and then we had another record. Maybe we're repeating that, but not really, because if you look at comparatively, we are, if you just scale back this, we are recovering very, very nice. Like even though the price has not reached to the cost basis, didn't touch or didn't go above the all-time high, but the risk level is almost less than what we saw in October 2021, which is really interesting. That means the cost basis of the market is not moving fast as well, and this is a sign of maturation. If we get to 120, hats down to whoever held, because I'm not a trader, but if I was a trader, I was expecting, as I'm going to show, a lot of traders actually made that position, and a lot of them are bleeding now. I was expecting at max get to the cost basis of short-term order 93, 96, and then market doesn't have enough demand. But it looks like demand is getting triggered by somewhere else. We cannot just rely on the on-chain and derivatives and look at the internal factors. Macro is becoming more significant. Getting back to the analyzing the risk. As I said, the MVRV that we showed is considering the cost basis of all investors. But we have repeated this fact that the short-term holder are the main driver of the immediate market moves. So if you want to speculate about short-term to mid-term market moves, you better focus on the short-term holders metrics in Onchain, which is literally reflecting the behavior and psychology of the recent investors. As I repeated like a couple of times in this report, we are above the cost basis of the short-term holders, and that puts the MVRV above 1. I think it's at around 109. That means the recent investors who bought in last 155 days are at 10% profit, which is statistically is not very significant. This is going to be significant when we see a 30% profit for the recent investor. Or if we go back to 2016, for the top, we saw almost 100%, 110% profit for the investors who bought like a couple of months before the all-time high. That's an extreme, but one standard deviation, which is like one range, the range that we saw since I would say October 21, almost last 4 years. This is a very reliable top. That puts us around 125, 126,000. So again, even if you look at the risk from the new investors' perspective, we get to almost the same number that we got by looking at the cost basis of the whole market in general. It is really interesting range if you get 125, and even though we got it, getting back to the cost for the short-term holders was significant, going to 125 is going to totally, for me, is going to totally delete the 4-year cycle, and I'm going to just confirm that those evidence is going to just strengthen my belief that I had since FTX. Because after FTX, I was believing the 4-year cycle is gone. We had enough like evidence that the MicroStrategy or Grayscale, and there was some talk about government, and then after El Salvador came in, I was seeing the evidence that other players who are coupled with the macro market are just gonna trade Bitcoin. They're gonna just have some influence on the market, and that's gonna literally break the 4-year. But 120 more than profit itself, it's gonna make me happy about just getting over that 4-year cycle. For many, still, it's a valid framework, which I think is harmful in long term. So far, any questions, Tina?
No, but I'm amazed some of the things you mentioned actually match other analysis, which is always great. For example, if we look at this thing that we were talking about, seems like if on this chart also, if we get to 120, we would be here. And then that's the same level of risk that we had after Trump election, and similar to what we had after ETF, with about like 10,000 difference. So yeah, I guess if we get to 120 or something here, we will trigger an overheat signal on many of the charts, including what you shared. Pretty interesting.
Yep. And I got to get to the scary part. So far we showed that it is a pretty significant move, and no one can deny that, especially looking at the cost basis of the short term and everything. The scary part, or I would say the lagging part, because we discussed last week that the derivatives were lagging. Flash news that today we could see the derivatives market is catching, and we can see some, at least the negative bias is flushed out. But what I really like to see, as I'm going to explain, is we see that FOMO. We see that appetite for longing the market. We see the open interest going up with the price. If we see those one, then the 150, because if you look around in crypto Twitter and Bitcoin Twitter, the 150 is the new price that everyone talking about. So if you get there and see the perpetual market especially is warming up, then I see more chance to, hey, 150 is pretty viable. But let's get to the not as scary. I better choose another vocabulary for this. Probably the metrics that makes me cautious, like put me in a situation that, okay, if these things get heated, these are the canary in the tunnel, and we're going to see, hey, market is getting exhausted. The first one is the short-term holder or the investors amount of profit, the profit they're taking off the table to the amount of loss, because there could be some recent buyers that buy at 106 and now is 104. They're realizing loss. That means they're just quick to realize some loss and get out of the market. When the ratio of profit to loss breaks above 3 or 2.5, you could see almost every time this happened, market couldn't sustain that momentum, and we had at least a 10 to 5 to 10% crash in the market. And if it was not met with new demand, if it was not met by the dip kind of investors, it actually get deepened. Right now, when we broke to 106, almost this metrics reached to 1.8, so not even above 2. If this metrics gets above 2, like the top in December or the top in the March 2024 or the top in 21, almost every single time we got to that level of profit taking by new investors, we should expect some sort of correction, which could be healthy. I'm not saying one crash means, yeah, we're going to go back to true market mean 66,000, but staying above 2 or reaching above 2, that makes me nervous for short term. How market reacts to that correction, potential correction, is going to determine the next move. So people should look for this metrics. It's very important. One of the earliest one, like as you can see, when it broke below -1, and because I think it's the log of that ratio, when the log of the ratio broke above 1.5, actually signed the bottom. It spotted the bottom. So even in the bear market, we can use this metric to track the tops and bottom. So the behavior of this metrics, like I said, is in log scale. If we see like close to 2, then you got to be careful, because the amount of profit taken off the table is strongly surpassing the amount of loss, and market is becoming overconfident. That's one sign. We have not reached that extremely heated values, but we are close, on the doorstep of seeing that number, maybe on the way to 120 that everyone talking about. We see this if we are destined to continue this rally. But that's one of the first metrics I check every morning. If we had a little bit rally, are we seeing that profit taking, blowing up, and market is showing some sign of risk? The other thing that I really like to talk about, and people can go back, our audiences can go back and look at the video we put out last week. I was talking about the short squeeze. You could see a lot of short position will get liquidated. Let me use the heat map. If you go back, this is the heat map by the CoinGlass, a beautiful chart. You could see when price was rallying from 85, it was price going up above 84, 85. You could see people were trying to speculate the market and betting on the downside. They saw a lot of very strong resistant or dense price level for people who were shorting around, I would say 88, then all the way to 96. You could see they got all just flushed out of the market. Then all the way from 96 to 100, all of them got liquidated. Now we are in the undecisive range. Like you could see the shorting is happening, but the longing has. So it's really the scalpers, if I say so. And people were extremely betting on the short-term market movement. But that short squeeze, if you go back to the open interest, you could see from 85, the OI was dropping, recovering a little bit, then dropping. That means that short bias was flushed out of the market. What I really like to see, especially if you go back to September and October 2024, you want to see, in correlation with price, in confluence with price trending up, we want to see the OI go up as well, because we have to look at the BTC term. Remember, if you look at the USD term, it's going to be so correlated with price, and it's hard to find any divergence or convergence. But if you look at the OI, if OI start to trend up with market going up, that shows the appetite for long in the market is back, and that is in confluence with the spot rally, forcing the price up all the way to 104. As we discussed in a couple of videos earlier in this video and the video last week, the spot-driven market was really evident. Now we want the perpetual market also, the futures market also show the same appetite, show the same momentum by looking at the price and OI going up at the same time, and OI in BTC term. So that one is still lagging. The positive sign was, yes, we saw the short side get flushed out of the market, That is very positive. On top of that, if you look at the funding rate when price reached around 96, 95 is just ramping up. SOPAR, which is kind of on-chain version of the funding rate, is positive, which is the ratio of the people who are spending, cost base of people are spending to the their spending price. If you go back, it is getting positive, very similar to September, early September or early October of 2024. This is getting positive, but if you look at the sharp move in the cost basis, let me zoom in the recent data points. We have not seen that appetite yet. I'm not saying it's impossible, but it is showing some positive sign compared to last week when we were saying, oh, there is no evidence from the perpetual market. It's purely spot market, and the derivatives market are lagging the momentum. So that is what we have to watch on top of what we just discussed about the short-term to short-term profit realized profit ratio to the short-term realized loss. So these are not as scary, but must be cautious about kind of metrics. But like I said, the price rallying to 104 is significant, so we cannot deny that. And if you go back and look at the amount of supply owned by the long-term holder and short-term holder, which is like literally the summation is almost plateau, the rest is in usually is excluded and is on exchanges and everything. You could see the short-term holder, the long-term holder supply is still rallying. That means despite the rally in the market, despite the possible people reacting to the rally, spending on profit or spending at break even, or long-term holder spending a little bit to the rally, still hodling is dominating the market. Some might look at this and say it's super bullish. I agree, it is bullish. That means long-term holder still feel they can see higher prices, or probably it's better to say the short-term holder who are spending are not very like spending a high rate that we saw. So even them are waiting and they're becoming long-term holder. This is kind of like positive sign, but I think we should not be over bullish when seeing this metric going up. Oh, everyone are hodling, because it could be partially due to the entities, like up to 30% almost of supply is held by the large entities, sovereign treasuries, exchange treasuries, fund treasuries. It could be the effect of these players joining the game and start to have a treasury, especially ETF and exchanges. You see a wallet not having too much spending last 1 year, but it is representing billions of dollars spot trading, and that profit and loss can be realized off chain. So we have to be careful. It is positive, but we should not look at it and say, hey, it could just be a sign of seeing 150,000. Because if you go back, this trend could go all the way like to what it was before the decline happening in this metric, like in the bear market. Go look at it. Like in the bear market, we saw it. In bear market, it can happen. So be careful about it. It's positive, but it is not like a metric.
But I see one difference. Like in most cases, when price was crashing, well, when price was rallying, a lot of new holders come in, and then the supply moves from long term to short term. So that ratio goes down. But what has happened in the last month is price has gone up, but also long-term holder supply has gone up. That's very interesting. So new investors are coming in, but the ratio of supply that long-term holders hold is actually going up.
Yeah. So I mean, it's very, very up to how like you interpret these metrics, because this is long-term going up. It is positive. It means like long-term holder are not spending, or if they're spending, the number of coins that are maturing from short-term holder to long-term holder is surpassing the volume of coins spent by long-term holder. The closing chart, I mean, the chart I'm going to use to close this analysis is the URPD, which is putting all coins available, all circular coins in a bucket, and that bucket is their cost basis. So we're looking at the distribution of the coin based on their cost basis. The blue color is long-term holder, so whatever coin you see at different cost basis, for example, at 70,000, this means like it's all long-term holder. And short-term holder is the red color. As you can see, breaking above 98, it was really significant, because not only we put almost 80 to 90% of the short-term holder in profit by breaking above 90%, and that was a dense 93 to 98, 96 was a dense supply zone, meaning a lot of people were hodling their coins with the cost basis around 93.96, and there was a chance they start to spend and get out a small profit margin or a break even. And we went above 198, and still they're hodling. It's very positive. The important part about this is the people who are in loss is the top buyers, the short-term holders, not the long-term holder, obviously, because long-term holders cost basis is way below the price. And breaking above 98 was so significant. Both had the chance to spend. Both had the chance to spend since then. I don't know how many days passed from 98,000, but they had the chance to spend, but they're still hodling. It's very important. And going back, I think it's around 20% of the supply had a cost basis above 93 or 18%. So that 18% have a cost basis above 98. It's staying above 98 and seeing these investors not spending, that means conviction. It might be like too early to say so, but if we see 1 or 2 week, these bars are not shrinking, they're not spending, then I just put another check mark next to the metrics that I will like, okay, we are seeing hodling, and that hodling is happening with the recent buyers that could spend at profit or could spend at break even, but they didn't. That would make the case, make the argument for people who are calling for 125, 150 way stronger. And we have to watch this. And the best way to watch this is looking at the change, because it is really hard to visually spot the change in these bars. What we can do is another version of this URPD, which looks at the change in the URPD. And this is the 30-day one, means looking at today's value of these all bars and compare it with 30 days ago. So when you see a negative bar, means over last 30 days, the people who were spent had the cost basis of around like 80. The majority have around 81 to 84. That was the majority of people like that they spent all over the last month through the rally. And the accumulation also is easy to spot with this chart from 92 to 96, exactly where we were expecting to many of these investors start to spend. We saw a strong accumulation. That is really interesting. That means those selling, whatever happened, met a very strong demand. And again, around 102 to 104, we see another buy pressure in the market. When market is rallying towards the all-time high, the recent all-time high, we see this strong buy pressure. Some may, it's this FOMO. Yeah, you can say it's FOMO because people are buying at the very close to euphoria phase. If we're not already in euphoria phase, based on many metrics, we might be in euphoria. But let's say we are going to the all-time high. A lot of people are buying, and we see that significant buy pressure accumulation. That is buy through the rally. Like buy through rally means you're either having too much conviction or you're hoping you see a price like 150. You're expecting the price to go way higher when you buy at, I don't know, 20% from the recent low, which was 74,000. So this is sign of FOMO, but by using the word FOMO, I don't want to be negative. I just want to say people who bought here were buying at extremely sharp price trending, a sharp uptrending in the market, and that is a sign of FOMO in the market. Okay, if this buying through the rally sustain, and we see this happens around like I don't know 103, and we see again market rallying up, the funding rate is just following the trend and going up, open interest BTC term going up. We see again like 2016, every correction is met with some buy the dip kind of behavior. That is all these signs are going to just check mark the hypothesis that 125 150 is very possible in this summer. But we really need to see the spend profit to loss ratio by short-term holder, funding rate, OI, and also this buy the dip behavior, which I'm going to show in a visual way. Is we need to see this one over long term. If you look at the rally post November 2024, the reason we stayed above 100,000 for almost 1 or 2 months was you could see the green means here is just accumulation. You could see the accumulation happen all the way from December to February. Even though we had a crash, still you could see the accumulation was happening. And right now, when we're rallying, we were correcting to 74, we saw a strong accumulation buy the dip. Textbook definition of buy dip at 83. We had again some buy the dip at 80 or 93. The reason we didn't see that much accumulation here is the reason is almost the same, that we didn't see accumulation from November 2024 to late November, mid 2024. It's because market is rallying so fast. There's no time to accumulate. So this is not concerning me. What is concerning me is, do you see these red bars? That means people are offloading with the cost basis of 97. So we saw that the spending, like I said, based on URPD, you could expect this happens. Like people are spending at the small profit margin, but the accumulation happened as well after. And again, at above 100,000, I think 104, we're seeing another accumulation. So that FOMO, that buy at the top, almost at every top, you see people are buying. This is in a strong case for FOMO. That accumulation is not as strong as what we saw at 85. This is towards the bias based on this chart is going to be towards the bearish side. But like I said, another positive signal from macro can change the scene. So far, it's been constructive, but it needs the derivatives. It needs the profit taking to cool down. It needs the open interest to go up to sustain this. And so far, we did. I mean, even now, I'm surprised that we got above 96. But if this signs that I just listed are seen, that surprise is over, and we can expect the 125, 1% deviation above the cost basis of the short-term holder, and market in general is very, like, the possibility go up, the probability go up, and like if anybody call for that, it's very reasonable after seeing all those signs that I just listed. Yeah, that's it. That's the Onchain side, and let's see what happens.
Yeah, thanks a lot for that great presentation. A lot of information packed. Yeah, so I think what we can conclude is, we had a very significant rally driven by macro fears getting lifted, and that rally took us from 75 all the way to 105, and it now has fully used up the fuel. It needs new fuel to go on. We do see a little bit of still buying pressure and a little bit of sell pressure. Overall, the market short-term outlook looks, to me, slightly bullish, but not as bullish. We need more progress. Like, we've had a lot of great news, and that has been reflected in the price, but we need more progress with the economy to keep going. And it's very likely that we get a lot of positive news from the macro side, but it's also possible that in the short run, like I said, we get a shock to the labor market, or some tariff-related setback. If one of the negotiations falls apart, we could have a short correction. But in our longer-term macro view, towards the end of the year, all this turmoil will be over, and then the discussion and narrative will switch toward tax cuts and deregulation. So where we are going, the destination is very, very bullish. Short term might be slightly turbulent, but if that happens, it's actually another fantastic opportunity to take advantage of, and we'll be there to monitor it. So any final words, Z?
No, that's all. Like you put it together very nice. All those signs that we list is needed if you want to see a sustainable market. But if you start to crash, the cost basis of the short term will around 92.3. It would be the first support that I expect markets show. I mean, that's where I expect some support there. So if I want to give it a range, 93 here, above all-time high 108, that's very well possible if we get the derivatives and a little bit like cool down in the profit taking. Then we can call for 125 to 1. I don't know. It's really hard to say any number above that. Not that it's impossible. We need more fuel, more energy from other aspects. So 120 and 93 is the range for short-term market moves. We have to see if we get close to any of these bands, then we can have another video and see what's happening.
Fantastic. So just final reminder, everyone, we write one article about the market every week. You can find it at 21stcapital.com/BI. With that, we just hit 1 full hour and 2,000 views across all platforms. Thanks a lot for your attention, and we see you next week. Thanks everyone, and thank you, Z.
Bye.